Well, for more on this topic, I'm joined by Carlo Dade. He's director of the Trade and Investment Center at the Canada West Foundation. Thanks for joining us.
My pleasure.
So given the ramping up of the tariffs and the expectations going into these trade talks, what does this decision to open up dialogue signal?
Well, it's part of the process that we would expect. The U.S. has, through their trade actions, engendered a response by countries around the globe. So the talks with China are, in one sense, part of that process. You know, there are talks with Korea that have led to an agreement on the imposition or the acceptance of tariffs, or not, sorry, quotas by the Koreans. The U.S. reports that they're close to having agreement with the Australians and the other countries on the quotas. So it's a process of talking to countries. Obviously, China is the most important in this process, but now that the U.S. has had what they would term progress or success with a handful of other countries, now is a good time for them to talk to China.
Now, let's look at the teams here. We see that China's Vice Premier Liu He, who leads the Chinese delegation, he says that the talks are to exchange views on bilateral trade. And then you have U.S. Treasury Secretary Steven Mnuchin says he's looking to have a very frank discussion on trade and the trade imbalance. But what are some more constructive ways, other than tariffs, for the U.S. to really address their trade imbalance concerns?
Well, it's, the domestic economy in the U.S., increased production, changed consumer demands. The U.S. are buying things from China because the U.S. needs these products, and this is obvious for anyone who deals with trade or business, but it's missing from the larger political discourse. So the trade imbalance arises from a host of reasons: production needs, input needs, and also currency. So the U.S. can talk to China about these issues, but at the end of the day, it's really more up to consumers.
And speaking of consumers, we noticed that the U.S. didn't target goods like clothes, shoes, and smartphones, things that would actually hurt U.S. consumers. So who ends up then bearing the brunt of these tariffs?
Well, if you talk to, I think, most trade economists, the response would be, at the end of the day, everyone's hurt. The goods and costs for goods that are subject to tariffs are passed on to buyers. And as those goods work their way through the supply chain, production chain, or just through retail establishments or through the economy, those costs hurt everyone. And if you're substituting domestic goods that are more expensive, well, then obviously everyone is paying for this. So at the end of the day, everyone hurts. But when you put in tariffs or quotas, or especially in retaliatory cases, you target things politically. So the tariffs that the U.S. have imposed are designed for domestic political reasons in the U.S., and the tariffs that China has imposed are designed for also domestic political reasons in the U.S. to inflict pain in key congressional districts or ridings in the U.S. To force a change of policy.
But let's look at the collateral damage now then. What's at stake for these multinational firms and the key trade partners? They're all tied up in this global supply chain. So where do they stand in these negotiations when you have the world's two biggest economies in this tit-for-tat standoff?
Well, companies that have supply and production chains that extend around the globe can look to try and move production or importing inputs or other needs from countries that aren't tied up in this. So perhaps moving imports from Vietnam or moving imports from Canada or other countries. That works for some of the larger companies, but only to mitigate the damage, not to completely prevent it. It's really the smaller firms that are stuck with one supplier, and that supplier happens to be China, who really stand with very little recourse. The time and effort to find a new supplier, to find a new partner, especially for these smaller and mid-sized firms, is much larger than it is for a large firm. So we tend to think about the large firms, but it's a smaller firm that is importing or trading directly from China that doesn't have many options, doesn't have a diversified supply chain, that could really get hit.
Now, China and the U.S., their economies are at very different stages of development, but China is continuing to open up its markets to foreign investment. It's also trying to address intellectual property protections and increase those, among other reforms. So these are some of the issues that the U.S. has raised. But what is the U.S. doing to make this a more welcoming environment for Chinese businesses and Chinese investors in the U.S.?
That's a good question. That would welcome someone who could actually fill that in and answer it. The issues with dealing with China and trading with China, on the one hand, here in Canada, China is our second largest trade partner, Yet there are still questions in places like Regina and Saskatchewan, where I am today, of folks not wanting to trade with China or not wanting to see more engagement with China. That goes directly against the reality that our trade with China is increasing without a trade agreement or anything else. So, the environment is partially conditioned on popular perception, and the popular perception is completely divorced from the realities of trade, in our case having China as our second largest trade partner. Until we can start to square that and get the public to realize how important this trade is and where it is, and the ability to disengage simply isn't there, you're going to have these political problems that continue to pop up.
All right, well, thank you so much for your insights. Carlo Dade, Director of the Trade and Investment Center at the Canada West Foundation.